Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Joe Biden cancels his final foreign trip as president as wildfires plunge Los Angeles into its worst natural disaster in decades. Hundreds of thousands are evacuated from Hollywood and other neighborhoods. Asian shares fall as inflation data shows Beijing's stimulus efforts failing to revive demand. The Fed cautions on future rate cuts, while President Biden is said to plan more curbs to keep advanced AI chips out of China and Russia. And UK stocks, bonds and the pound tumble, adding to borrowing costs and piling pressure on Chancellor Rachel Reeves to calm investors over the government's fiscal plans. Happy Thursday. Markets then looking for direction. We had the Fed minutes yesterday where the caution was reiterated. Of course, the data, the lines coming through for that meeting of December and certainly flagging inflation risks to the upside. That was one of the key takeaways. European futures currently pointing to losses of about 0.1%, flatlining essentially across US markets yesterday. We look ahead to the non-farm payrolls data tomorrow. Potentially that is the catalyst. The UK story, though, is now front and centre, given the sell-off in assets that we saw yesterday. Yields up, the pound down. What does that tell us about international investor appetite for UK assets? FTSE 100 futures currently pointed to modest gains of 0.1%. The rout particularly felt on the FTSE 250 in the equity space yesterday. S&P futures stateside pointing to losses of 0.2%. Nasdaq 100 futures looking to drop 39 points. There's additional restrictions being reported by Bloomberg when it comes to Nvidia chips and AI chips, particularly with the focus on US adversaries like China and Russia. Let's flip the board and have a look cross-asset then. That sell-off, the four-day sell-off in US Treasuries, yields up, not just US Treasuries, of course, but global bonds, easing in the session today, at least for now. You're seeing bit of money moving in across the Treasury curve. It will be a shortened trading day as the US, of course, marks the passing of President Jimmy Carter, former president. 466 right now on the US 10-year. You are seeing yields down close to 3 basis points. The pound continues to be in focus after a drop of 1.3% yesterday. The pressure is still there for sterling, down 0.3 at 123. Brent 76.22, currently up 0.1%. Bitcoin still below $100,000 at 94.36 right now, just down 0.1% on the largest crypto by market cap. Let's cross over to Asia right now. Some really important data, particularly in terms of the inflation front. Two different dynamics out of Japan, but the focus really on the inflation story or deflation story of China. Avra Hong is in Singapore.
Yeah, Tom, I think it's the lack of inflation in China that's really worrying investors. And this is, on a day where Asia markets are already really cautious. You look at the declines for a second session. They're headed for a weekly loss on the MSCI Asia Pacific amid caution. Not a lot of risk appetite given the Fed signals, the concerns surrounding potentially Biden furthering more restrictions on chip exports, and then add to that the China data, right? So what we're really seeing is consumer inflation weakening for yet another month, now nearing zero. And you look at the producer price data as well, that deflationary trend for a 27-month, very much intact, clearly showing you an economy that despite stimulus efforts, it just hasn't been enough to stimulate demand, which is what policymakers certainly want to see. So Chinese stocks are extending some of the declines that we already saw earlier in the session, slipping deeper into negative territory. Japanese equities are underperforming today. Let's flip the board and take a look at how we're faring in the currency space, because, of course, amid the specter of elevated US yields, greenback strength, Asia currencies have been succumbing to that. And among the data points that we're seeing out of China, that's really putting upward pressure on dollar China. So that's kind of forced the PBOC's hand in terms of support via the yuan fix that we got today, another really strong one, but also via plans that it announced today that it's going to issue record amount of Hong Kong bills. This is another way for it to add to demand for the renminbi. As I say, the yen is among those currencies that are weakening in the Asia Pacific. But flip the board, because I want to highlight why we're seeing a bit of firmness in the Japanese currency today. Some of this has got to do with the consolidation in the US dollar, but also after data out of Japan showed base pay climbing by the most in more than 3 decades. And of course, when it comes to Japan and the policy expectations, what the BOJ wants to see is that positive picture on wages, stimulation of the Japanese economy, enough for them to take their foot off even more from the stimulus pedal, so to speak. So this is a positive sign, but at the heart of the matter is how traders are not convinced that the Japanese policymakers are serious about hiking or tightening later this month. If you look at the pricing in the swaps market, it's still 50-50 for a couple of weeks from now. So you're seeing some firmness in the Japanese yen, but overall it's still a story of weakness in the yen. Tom.
OK, still lacking conviction on where the BOJ goes next, even if they get that tick in the box when it comes to the wage story. Avril Hong in Singapore with a check on the Asian markets. Thank you, as ever. To the Fed right now, where we've got the minutes, of course, the latest minutes showing that officials are eager to slow the pace of rate cuts. Meanwhile, Fed Governor Chris Waller says he believes inflation will continue to cool towards the central bank's 2% target.
My bottom line message is that I believe more cuts will be appropriate. If the outlook evolves as I have described here, I will support continuing to cut our policy rate in 2025. The pace of those cuts will depend on how much progress we make on inflation, while keeping the labor market from weakening.
OK, let's bring in Bloomberg's Valerie Teitel. And Valerie, arguably the Fed minutes, even though they were backward-looking, drew specific attention this week, given the global bond rout that you have been breaking down for us through this week. What stood out for you from these Fed minutes? Does it change the way we think about the Federal Reserve going forward? Well,
look, Tom, thankfully there were no hawkish surprises in those Fed minutes yesterday. And specifically, there wasn't anything hawkish from that Waller speech that we heard yesterday afternoon. It was his dovish comments that really calmed the bond rout, at least in the Treasury market, for instance. He did say that he believed inflation will continue on its trajectory downwards. He does support further rates cuts, but it was his comments on tariffs which the market found specifically interesting. Especially, he said that tariffs, he doesn't expect them to have a significant impact on inflation. He noted the broad uncertainty around that, though. He went on to say that tariffs are unlikely to shift his view on monetary policy. This calmed the market down a bit, and we didn't get any surprises in the minutes. We flip on, just check on how the bond market has been faring overnight, because again, we are seeing a bit of calm when it comes to the Treasury market. It is an early close, Tom, for Jimmy Carter's funeral taking place in Washington later today, a 2 p.m. Eastern time close. But that lack of liquidity, perhaps we will see a bit of calm when it comes to the Treasury market today. Eyes on that 30-year yield, again, 490 on that bond. There are some other markets, though, Tom, which have not found calm yet.
Yeah, well, certainly. And certainly there are links, clearly, between what's happening with the Treasury market stateside and the sell-off that we've seen that is now, as you say, on a bit of a pause, and what's happening globally here in the UK. Let's cut to the chase. Are we on the fringes right now, Val, of a market crisis here in the UK?
Look, Tom, the market is definitely drawing analogies to what's going on now, to what happened in the Liz Truss episode in 2022. I wouldn't put it past that this narrative keeps growing unless we hear a change of direction from Rachel Reeves. We saw this long end weakness again gripping markets yesterday. This 10 basis point rise in the 30-year yield has almost certainly eroded the government's fiscal headroom. The market does await more comments from the government. Will Rachel Reeves come out to reassure markets in the coming days? But we also saw such a big reaction when it comes to the currency. Cable taking a big dive yesterday, down some 1.3% at one time during the session. We did hear reports from market traders saying there was large downside options bought in the market. So a big flurry of positioning to protect from further losses when it comes to the cable currency.
OK, the focus still clearly on what's happening with these UK assets, given the pressure here. Certainly the Chancellor, Rachel Reeves, and anything she says will be scrutinised. Bloomberg's Valerie Teitel, thank you very much indeed, breaking down what we're seeing in terms of the global bond markets with that underscore in terms of the UK and the challenges here. To the US right now, this is the major story, of course, stateside. Joe Biden cancelling his final overseas trip as US president in response to those devastating fires raging in California, specifically, of course, Los Angeles. The uncontrolled wildfires are still burning through parts of the state, fanned by hurricane-strength winds. Let's bring in Bloomberg's Michelle Ma, who is in Los Angeles for us. Michelle, thank you for taking the time to give us an update. What is the latest?
So the latest, unfortunately, is that the biggest fires, that is the Eaton fire and the Palisades fire, are both still 0% contained. And on top of that, we've just heard news of another fire that broke out today in the Hollywood Hills, the Sunset Fire, and a few other fires around the region. And notably for the Sunset Fire, the evacuation zone for that includes some pretty iconic LA landmarks like the Hollywood Bowl and the Chinese Theater. And together, I think more than 100,000 people have evacuated due to these fires. And we've heard of, unfortunately, at least 5 deaths. So, I spent all of today talking to evacuees at shelters and folks throughout the west side of Los Angeles, some who have lost their homes already and everything that they own. And a few of them have compared this fire situation to the 1994 Northridge earthquake, which totally devastated the city. So it's truly a big, big disaster. And I think the economic impact so far have been estimated at over $52 billion.
52 billion US dollars. You're saying there's 0% contained in terms of the major fires still. So there's a chance that this spreads from here. Michelle, you've touched on the human cost, the potential economic toll as well. Why are the fires so bad this time around? What are authorities doing to respond? We're hearing of firefighters having to draw water from swimming pools, for example.
Yeah, I mean, I think it's a really unique set of circumstances that they're dealing with right now that are honestly very unprecedented. So Santa Ana winds that they're experiencing, that's pretty typical for this time of year in this region. But what's not typical is the fact that, January is typically rainy season here, but we've been dry for months. And so add on top of that, the fact that we've had extremely high winds, and it's just a problem that's been waiting to happen. And, from what we're hearing and seeing is that these winds are going to continue to stay high, lasting through Thursday. And, there's a potential for another windstorm next week with no rain in between. So it's altogether a pretty dire situation.
Meanwhile, President-elect Donald Trump has blamed California's governor, Gavin Newsom, for the deadly fires. Let's listen in to what incoming President Trump has been saying.
It's very sad because I've been trying to get Gavin Newsom to allow water to come. You'd have tremendous water up there. They sent it out to the Pacific because they're trying to protect a tiny little fish, which is in other areas, by the way, called a smelt. And for the sake of a smelt, they have no water. They had no water in the fire hydrants today in Los Angeles. It was a terrible thing. And we're going to get that done. It's going to finally be done. I got it done from the federal side, and he didn't want to sign it, but it's not going to happen again like that. There's no reason.
Look, Michelle, clearly, history reminds us that incoming President Trump and Gavin Newsom, the governor, of course, of California, no love lost between these two. Is this a political knock that Trump is landing on the governor? Is there anything justified in what he's saying? What do we make of what the incoming president has been saying, how he's been characterizing the events on the ground in LA?
Well, look, I've been looking at the water issue all of today and talking to folks on the ground and people who are experts on this subject. And it's clear that, Republicans like President-elect Trump have been using the fire hydrant issue to push for transferring water from the north of the state. And they argue that it's being wasted to protect this endangered fish. But the experts that I spoke to say that argument is essentially a red herring. And, yes, it is true that there have been dry fire hydrants in some of these places where firefighters need water. But, water and wildlife researchers I spoke to and former firefighters say that has more to do with kind of the increased and unprecedented pressures on these water systems than actions of the governor. So these are water systems that were not made for these kinds of conditions. Think pumps, tanks, generators, the reservoirs themselves. I mean, these are systems that are in many cases very outdated, and they're not equipped to handle the enormity of what they're dealing with. And so these folks that I've talked to are saying that the focus really needs to shift instead to a real discussion about upgrading our infrastructure to be able to handle these kinds of fires. And honestly, more importantly, figuring out who at the end of the day is going to pay for these upgrades and how.
OK, Bloomberg's Michelle Mark, really appreciate your time and your insights on the latest on the ground in LA. Joining us, of course, out of Los Angeles. For the latest updates on those deadly wildfires in LA, you can go to T-Live Go on the terminal. It is updated on a minute-by-minute basis. Here's what else we'll be thinking about in the day ahead. 7 a.m. UK time, we're going to get German industrial production data, so another touch on the health of the German economy. At 9:15 a.m., meanwhile, UK time, we're going to get a French bond sale. So again, a reminder of just the enormity of sovereign debt that's been put into the markets at this moment. We'll see how well absorbed that is going to be by the markets, given the political tensions over in France. And at just past 2 p.m. UK time, we're going to be hearing from the Fed's Susan Collins as well. So we'll see if she aligns with the consensus coming through from Fed officials, FOMC officials, that they can take their time on future rate cuts. What she has to say, of course, about the path ahead will be important. Coming up, UK borrowing costs, meanwhile, soaring, stocks falling, and the pound tumbles, putting more pressure on Chancellor Rachel Reeves to reassure the markets on her fiscal plans. So far, they are less than reassured. We look at her options next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, UK markets tumbled yesterday, pushing 30-year gilt yields to the highest level since 1998. In a rare intervention, the Treasury has signalled that if higher borrowing costs wipe out the Chancellor of the Exchequer's fiscal headroom, she'll choose cuts to public spending over tax hikes. For more, let's bring in our UK correspondent Lizzie Burden. This is a challenge, to say the least, for Rachel Reeves. We are having flashbacks to Liz Truss. We're having flashbacks to the mini-budget. We saw the moves in yields. We saw the pressure on the pound. Those two dynamics suggesting that investors are turning sour on UK assets. What is Rachel Reeves to do?
Yeah, we're also having flashbacks to the 70s, Tom. Let me give you the big picture.
70s?
Well, exactly. Running up to the election, OK, the Labour Party really contrasted themselves with the Conservatives by saying, remember the spectre of Liz Truss? We'll give you fiscal responsibility. And in doing so, Rachel Reeves has put herself in a straitjacket. Since the budget, she said there'll be no more tax rises, there'll be no austerity, there'll be one fiscal event a year, and she'll stick to her fiscal rules of only borrowing to invest. So she's really boxed herself in here. And this is high risk because at the October budget, she left herself a razor-thin margin for error, really relying with a hope and a prayer that the economy was going to grow. And we know that growth has been in the doldrums. So then, after the budget, she sat down and you had the yield spike and pretty much that headroom was evaporating. Now you've got this global bond rout and she's really boxed in. So what's she going to do? Well, she tried to calm the market yesterday. She's off to Beijing at the weekend. That's really about the long term, to try and rustle up more investment for the future, but she needs to deal with this now. She was planning to do a speech when she got back from Beijing, reaffirming her commitment to the fiscal rules. But if we continue to see these difficulties in the markets today, there's an expectation, isn't there, that Reeves needs to say something. At the moment, what we got yesterday was this signal that if she ran out of headroom, she would choose spending cuts, as you say, over more tax rises. But that's going to be politically difficult. And the reason I say that it's more like the 70s perhaps than Liz Truss is because at least Liz Truss had an idea of how to grow the economy in her tax cuts. It looks like, according to the former Bank of England policymaker Martin Wheel, she might have no choice but austerity.
Yeah, what happened to that 2.5% growth target for this Labour government? The jobs data, meanwhile, the job situation, the labour market in the UK is softening all of the time, where it seems the BOE is less and less convinced that it can go further with rate cuts in a rapid sense. There are tensions here when it comes to the labour market.
Really so. And remember, the official jobs data have been the bane of Bank of England policymakers' lives. They've been so unreliable since the pandemic, no one answering their phones. So BOE policymakers looking very closely at these private private surveys. And this one is in particular interesting because vacancies have fallen at the fastest rate in 4 years. They've been coming down in general, but this is a sudden jump. And it's not because people are filling the vacancies, it's because companies are taking these jobs off the table. Now, this comes back to Rachel Reeves's headache because it's not a sign that the economy is doing well, is growing, is going to give her more headroom. And if it doesn't grow as fast, it just adds to her headache.
Yeah, I mean, arguably it comes back to that budget and the increase in national insurance contributions for businesses, doesn't it? And they're having to rein in the number of jobs that they can actually put out on the market. Elizabeth, an excellent breakdown of what is happening here in the UK, of course, in terms of the sell-off that we've seen across assets and what this all means for the Chancellor, Rachel Reeves. Has she boxed herself in, or was she boxed in by circumstances? Presumably she'll be making that argument at some point. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. We had some breaking lines just a minute ago or so from the Swiss National Bank in terms of the profit that is turned on its FX holdings for 2024. So the SNB has reported an 80 billion Swiss franc full-year profit for 2024. It made a small loss on the Swissy itself, but of course it has accumulated a stockpile of FX reserves, international FX reserves, and it has made a profit on that as well, of course, on its gold holdings as well. So it is able to return some money and some of that profit, it seems, to the state, the Swiss state, but also the individual regions, the cantons as well. So making about an $88 billion profit for 2024, and it has then been able and will be able to resume payouts to state coffers. It gained, as I mentioned, on its gold holdings, and it will be making a payout of 3 billion francs to the federal government and those regions for the first time in 3 years. Also paying a dividend to its private shareholders. So some gains coming through for the gold positions and international FX holdings of the Swiss National Bank. The Swissy versus the euro currently at 106. Now, some other stories making the news this Thursday. Advisors to President-elect Donald Trump are said to be considering Michelle Bowman as the Fed's next vice chair for supervision. Michael Barr has said he will step down from the vice chair role while retaining his seat on the Fed's board of governors. Trump's advisors have also begun drawing up a short list of potential replacements for Chair Jerome Powell, whose term ends in May 2026. A union representing US dock workers has reached a tentative deal with port operators for a new 6-year contract, avoiding a possible strike. Bloomberg has learned the agreement guarantees union jobs when certain technologies are implemented, including the semi-automated cranes that had been a sticking point. The deal still needs to be ratified by the two sides. An estate funeral is taking place in Washington today for former US President Jimmy Carter. His body has been lying in state at the Capitol, where members of Congress have been paying their last respects. After the service in Washington, Carter will be taken back to Georgia for a private burial. You're seeing live pictures there. US cash stock markets are closed for a national day of mourning. We will have special coverage of the funeral from 2 p.m. UK time. We'll leave you of live pictures of the former president lying in state in the US Capitol. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Joe Biden cancels his final foreign trip as president as wildfires plunge Los Angeles into its worst natural disaster in decades. Hundreds of thousands are evacuated from Hollywood and other neighborhoods. Asian shares fall as inflation data shows Beijing's stimulus efforts failing to revive demand. The Fed, meanwhile, cautions on future rate cuts, while President Biden is said to plan more curbs to keep advanced AI chips out of China. And UK stocks, bonds and the pound tumble, adding to borrowing costs and piling pressure on Chancellor Rachel Reeves to calm investors over the government's fiscal plans. Checking the markets right now, still looking for that catalyst. Yes, you did have, of course, the minutes coming through from the Federal Reserve. Again, reiterating the message from these FOMC officials that they see upside risks to inflation. Interestingly, starting to parry some of their forecasts, some of their expectations around potential Trump policies, for example, around tariffs, into their forecasts as well. European futures currently off 0.1%. Worth noting that US markets, of course, are closed today as the country marks, of course, the funeral of former President Jimmy Carter. You had a successful and well-received sale of $22 billion of US Treasuries yesterday, and some comments from Chris Waller that seems to at least temporarily calmed the Treasury markets. We'll get a touch on that shortly. FTSE 100 futures currently pointing to gains of 0.2% after the rout, of course, particularly on the FTSE 250 yesterday. UK assets really taking a knock in the session on Wednesday. S&P futures then pointed to losses of 0.2% when markets reopen, not later today, but of course on Friday stateside. Nasdaq 100 futures also pointing lower by 37 points. Let's flip the board and look cross asset treasuries then. You do see a bit of relief in the session day after 4 straight days of selling with yields up. Currently, yields down close to 3 basis points at 4.66 on the 10-year. The pound, after a rout there of about 1.3% drop yesterday, currently 1.23. Further pressure on the pound today, down 0.4%. Will the Chancellor have to respond more vocally? Brent, $76 a barrel, currently flat, and Bitcoin below 95,000, down 0.1% in the session. Let's get to the major story unfolding stateside, though, because uncontrolled wildfires are still burning through parts of California, fanned by hurricane-strength winds. The fires, which have forced more than 100,000 residents from their homes, are the worst natural disaster for Los Angeles in decades.
I am making sure that we leave no resource untapped. Firefighters are now on scene from across the state and across the country.
OK, for more, let's bring in opening trade anchor Kriti Gupta, who's been following this for us. Kriti, are the authorities on the ground in Los Angeles any closer to getting these fires under control?
They're not. In fact, further apart, I think, is a more apt way to put it, simply because this is a fire that started off in the Pacific Palisades community, so Northern California, and it kind of made its way down. It's now engulfed almost 11,000 acres in California due to a lot of those strong winds, but now it's affecting more kind of city dwellings. This was initially affecting more affluent neighborhoods slightly outside of kind of the core of Los Angeles. You now have evacuation warnings around some pretty notable international landmarks, the likes, for example, of the Hollywood Bowl, the Dolby Theaters, the latest mandatory evacuation coming from Hollywood Hills and Beverly Hills. So this is a really kind of quickly developing situation, one that is very challenging to get under control, not just because of the power of the wildfires, but because of the terrain there as well. And this is simply one that it means a lot of people get very short notice to evacuate their homes. And that's where you're seeing some of these tragic images come about.
Yeah, the images are stunning and, of course, disturbing as well. There is the human cost. There's the economic toll as well. On both metrics, where do things stand? Obviously, the primacy of the human toll right now, but we will have to think about the cost at some point.
Absolutely. So 11 million people in California affected by these wildfires specifically. And this is a recurring theme. We know that a water shortage has been an ongoing conversation for years in California, specifically because of the kind of climate risks that are associated with this region. But you mentioned it in your intro there. You haven't seen a disaster of this scale since going back to 1994, an earthquake that had similar sorts of damage. And these are firefighters, by the way, that are working around the clock to try to kind of limit that human toll. They have been good about actually being able to get people out of their homes as quickly as possible. And I think the message has been received from the residents on the ground that if you see a whiff of that kind of risk, you flee your home. And a lot of people have done that, just speaking from personal anecdotes as well. The liability piece, the insurance piece, is another angle to look at, absolutely, because in the last kind of couple of years, you started to see this thing called last resort insurance, where basically a lot of the traditional private insurers are choosing not to insure those parts of the country that are more vulnerable to climate risks, including California, parts of Florida, et cetera, to the point that people who are living in that part of town or part of the country now have to go to this thing called last resort insurance. It's often a little bit more expensive because of the kind of risks attached to it as well. But you've seen a doubling of those kind of plans since 2018, liabilities crossing that $1 trillion threshold. So some pretty big numbers there. You also have to consider the fact of how quickly disaster aid can get to these regions. Remember, the U.S. government, we know Joe Biden is canceling his trip to Italy to deal with the issues at home and, of course, the wildfires. The U.S. government has also been dealing with fires in Hawaii, hurricanes in North Carolina, hurricanes in Florida as well. So in terms of disaster relief, there's a question of federal response that, of course, will be top of mind for the new president.
Yeah, and of course, scientists linking those events to the climate crisis, something that the new president has described the climate crisis as a hoax. So there's that tension as well over the next 4 years. Opening trade anchor Kriti Gupta on the here and now of what is unfolding and the dramatic images, the human impact, the economic toll as well. In Los Angeles, thank you. Opening trade anchor Kriti Gupta. For the latest updates on the deadly wildfires in LA, you can go to T-Live Go on the Bloomberg terminal as well to get up-to-minute updates on what is happening on the ground. Now, some of the stories making news this Thursday. BlackRock has told employees it is cutting roughly 1% of its workforce, affecting about 200 people. The job cuts are part of the company's efforts to realign resources and come after it committed over $25 billion for takeovers to expand its reach in private market assets and data. The firm says the recent acquisitions will add another 2,000 roles this year. Jefferies has reported profit that soared in the fourth quarter on a rebound in M&A and a surge in equity trading revenue. Signs that the deal-making slump is coming to an end. Net income more than tripled after a 73% jump in investment banking fees and a near doubling of advisory revenue. And the UK's Prudential Regulation Authority, the PRA, says plans to ditch some of the restrictions on banker bonuses will introduce more risk into the country's financial system. The new rules shorten the waiting period for top managers' bonuses from as long as 8 years to 5. They come as part of the PRA's efforts to comply with government orders to support the country's growth ambitions. And new research from Bloomberg Intelligence about the impact of AI on the banking industry finds that 200,000 jobs could be lost over the next 3 to 5 years, but profits could jump by up to 17%. Thomas Notzel, senior banking analyst at Bloomberg Intelligence, joins us for more. This is a great piece of research, and it's going to grab some eyeballs, certainly amongst our viewers. What are the key takeaways? I mean, there's the profit upside, but then there's a real impact on jobs.
Absolutely, yes. Thank you very much, Tom. So, first of all, the most important key takeaway from that research is that the banks are very much bullish on productivity gains from AI. If you look at the cost, they expect the cost to remain relatively flattish in the next 3 to 5 years, which proves the point that AI is quite expensive to introduce, to implement, but also expensive to maintain. And in terms of the job cuts, yes, it's around 200,000 jobs to be lost in the next 3 to 5 years. It's around 3% of the workforce of the banks which we are covering. So it's not a massive figure, you would think so. But plus also think about the fact that last year, 10 European banks cut almost 25,000 jobs, right? So I think it is a natural way of banks cutting costs by cutting jobs. Plus, we have to also think about AI. AI is not just about job replacement. AI is also about job creation. That's why I think this 3% includes as well some new jobs being created, including compliance, governance, data scientists, etc. So there will be some jobs that will be created, new functions will be created, and will attract some talent.
What does it mean for profits?
In terms of the profit, as I said, the productivity boost is the key drivers, according to the banks which we surveyed. Up to 17% pre-tax profit could be boosted as of 2027. Well, more than 80% of the banks claim that the sales generation will increase by at least 5%, which can be quite bullish, we would say. We are more cautious because we have to look into the fact that no regulator can be a little more scrutinizing what the banks are doing with AI and most importantly with Gen AI. Moreover, there's a competition coming not only from between the banks and AI, but also from fintech world, right? So non-banking institutions, we want to as well eat cake of the revenue. So there's a competition coming as well. So we have to take all this into account if you think about the profitability boost and the revenue generation.
Back to the jobs picture then. 200,000 jobs. As you say, given the context of what, 25,000, you said 25,000 jobs.
Last year, by 10 European banks.
Just last year. And you're talking about 200,000 over potentially 3 to 5 years. Which jobs are most vulnerable then from AI?
we didn't specifically ask banks about this question, but if you read the transcript, if you follow the industry, you definitely realize that back office, middle office, that repetitive tasks can be replaced. Customer service, probably use bank services in the UK, and you talk to chatbots, you talk to robot, and then you talk to the agent, right? So this kind of jobs will definitely be replaced in the first place. But these jobs can be the free time may be used in different more value-added services by the bank. So I think there will be definitely transformation of a workforce in terms of the mix, how much banks will hire in back office, middle office, and how much of new jobs will be created. And I think this can change in the next 3 to 5 years.
Did you get a sense that banks understand what they need to be investing in when it comes to AI and how much dry powder that they are putting aside? There are all these different products, all these different models, all the different services layered on top of those models. Do banks know what they should be adding and how much they should be spending? And
that is a very interesting question, right? If you look at the banks at the moment, for the last 2-3 years, they have been benefiting massively from high interest rates, so they have quite good revenues, good stream, good cash that they can spend into AI. And where they're going to be investing this is a very interesting question. That's why we did the survey, to understand what are the priorities, because banks are not so much disclosing those in the transcript during the earnings calls. And do they know? I think it's a touch and go. They will investigate some areas. They have to be concerned about the regulatory regime as well coming through as well. So it's quite difficult. And banks, I think management is having a difficult job and task right now to identify the areas where they can really have big impact of AI. And we have a nice tracker in our research as well. You can see what the banks are doing in terms of AI, which areas, which businesses are affecting more. And I think only JP Morgan is the one which is actually quite open about what is the implication, the impact of AI on their businesses. And they claim that up to $2 billion of benefits in dollars can come from AI this year, and it can go even more this year, right? So banks slowly start talking about this a little bit in more details. And we expect this will be even more investigated by analysts and investors in the coming quarters, because they want to really understand what's going to happen in the banking landscape in the next 3 to 5 years and beyond that.
Okay, so JP Morgan have put a dollar number on it, and you expect more banks to be kind of quantifying it and disclosing it in the months and quarters ahead. Really great piece of research, really well worth your time as well on the Bloomberg terminal and of course on Bloomberg.com as well. Thomas Nerzl from Bloomberg Intelligence with the smart insights in terms of how AI is reshaping and affecting this finance sector with a particular focus on banks. Staying with banking, today's Bloomberg Big Take takes a look at former Wall Street analysts who are turning to social media and content creation to make a living. Compared with their post-financial crisis peak, the biggest banks globally have slashed equity analyst jobs by over 30% to lows not seen in at least a decade. Bloomberg's story, which you can also read on the terminal, talks to a former analyst who's now plying his trade on YouTube, giving his irreverent investment takes behind an avatar of Shrek. So that's how you reposition if you are an analyst out of work. Well, that's also worth your time. Bloomberg's Big Take that you can get on Bloomberg.com and the terminal. Coming up, the global bond sell-off could push yields further towards CRE thresholds. We've already seen, of course, longer data yields in the US and the UK getting above 5%. We're going to discuss next with Alexandre Drabowicz from Indosuez Wealth Management. Get the views on what is happening with this global bond rout that has, in the session today at least, taken a temporary pause. This is Bloomberg. Welcome back. UK markets plummeting. You saw that pain across the screens yesterday, causing anxiety about the economy and pressure, of course, on the Labour government. For more, let's bring in Bloomberg's Valerie Teitel. Valerie, put to us in context the magnitudes of the moves we saw yesterday. It is not receding today. The pound under pressure again.
Pound under pressure again, down some nearly 0.5% so far in this morning's trade. And unfortunately, Tom, the markets are telling the UK government they need more reassurance. They need more. The problem is, what more can the government give? We've already heard some sources saying that Rachel Reeves is looking at cutting spending. Well, that is going to hamper growth. And if you are saddled with debt, you need to grow your way out of it. There's no way out except for growth. And unfortunately, the market is just saying we're not sure where that growth is going to come from. It goes back to this narrative that, the UK needs to compete for finances on a global stage. And if you have treasury yields at 5%, that means the yield at which gilts need to be at is high enough to destabilize the government's trajectory. It's going to create debt to GDP ratios that are only going to climb, interest rate costs that are only going to climb. And you can almost think about the U.S. being some massive black hole with its own gravitational field. It's sucking in all this capital from the globe and leaving others like the UK needing to compete with it on a global scale, leaving those gilt yields at a penalizing high level for the UK government.
Yeah, we're looking exposed with those 30-year yields at levels that we haven't seen since I was listening to Oasis back in sixth form. Valerie Teitel, thank you very much indeed on the market breakdown, the impacts across the UK with the pressure on the pound again today. Let's get further details and analysis in terms of the global bond market sell-off, the sell-off that keeps, of course, flaring across global markets, taking a bit of respite stateside today, and trading is shortened with US Treasuries, given, of course, the marking of the state funeral of former President Jimmy Carter. But, of course, escalating concerns are there about inflation, politics. We've had a reminder of that from Trump this week. And, of course, those government debts. Let's bring in right now Alexandre Drabowicz, the CIO at Indosuez Wealth Management. Alexandre, thanks for your time this morning. How far did this global bond market sell-off go, do you think? The respite that we're seeing in US Treasuries today, is it going to be short-lived?
Good morning, Tom. Thank you for having me on the program. Well, if you look at the parallel of 2016 during the first Trump presidency, actually the trajectory is more or less the same. It's a readjustment of about 100 basis points from the lows to the highs. So if you look at the trough in mid-September to below 370, I think we have done most of the readjustment. Now, as usual, with fixed income, you can exaggerate on both sides. We have seen a lot of volatility in the past 18 months. So yes, it can exaggerate and we can have a pickup. And I'm just surprised, when yields were below 4%, nobody was talking about 5%. And now that we're at 3.7, everybody fear that we didn't go to 5%. My intuition is that we are not too far away from a stabilization. And back to what Valerie was saying, I can actually say that we, Indosuez, as a private bank, we see a lot of interest at the current level of interest rates. So locking in yields at this level for private clients in the US start to be attractive.
OK, so that history would support that, wouldn't it? Recent history. You get to about 5% and investors start to lock in those yields, and it puts something of a ceiling on how high yields go at the long end for the US. You think that scenario plays out again, Alexandre?
Absolutely. You look today, when you take a little bit of credit spreads, investment grade and high yield on the extremely high quality issuers, where there has not been any particular spread widening, default rates continue to be low, US economy is really resilient, you can easily achieve 6.5% yield for the next 5 years. So compared to money markets at 4.5% and probably heading to 4%, you are able to lock in a decent amount of yield, which, over the next 5 years will actually give you a fairly, well and stabilized outcome for your capital.
How are you modelling potential inflationary impacts from incoming tariffs?
Yeah, of course, this is one of the key questions that definitely contributes to this bond yield move. I think that, one of the key words today or yesterday night from the Fed minutes is uncertainties. They actually use that word 9 times. And last time was only 4 times. And the reason this is because they just don't know about the tariffs. The intuition, of course, is that some of those tariffs are going to be inflationary. We ourselves have slightly revised our forecast for inflation by 20 basis points for 2025. So it's not a massive spike of inflation, but we need to reflect the uncertainties regarding both trade policy and immigration policy. Now, is Trump going to go as far as to put a massive amount of pressure on inflation? Probably not. The Fed needs to obviously to take this into account today. What is probably smart about the way they are managing today between inflation risk and labor market risk is to keep some optionality. Today, the market is forecasting only 2 cuts, which seems to be fair. But if tomorrow, and we will see the non-farm payrolls on Friday, we start to have some weakening number of the market, the Fed can easily shift from its focus on inflation back to the labor market.
Okay, yeah, the focus has shifted, hasn't it? It's been back and forth. Currently, it seems to be on inflation. We had a reminder of that from the Fed minutes that you referenced. But whether or not non-farm payrolls tomorrow moves it back to the labour market, of course, which was the focus for much of last year, is going to be a key question. So, Alexandre Drabowicz, CIO at Indosuez Wealth Management, thank you for your take on what you're seeing across these global bond markets, and with the view there that investors will be looking to take advantage of higher yields at around these 4.8 to 5% levels when it comes to longer-dated US Treasuries. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. So the Fed minutes of yesterday confirming that officials within the Fed at the FOMC are tilting now more hawkish. They really underscored what they described as the upside risks around inflation. They talked about the strength of the consumer. They talked about the relative strength of the labour market and the overall strength of that US economy. The focus then, the spotlight on those inflation risks. And interestingly as well, and by the way, this terminal chart shows how the breakdown of those members within the FOMC have and are now tilting hawkish. Interesting to see that they've also been factoring in some of these they call them placeholder assumptions around Trump policies. Think tariffs, of course. They are starting to factor those in. They did start to factor those in back in December in terms of their forecasts as well. That will be and come into clearer focus, you would assume, in the months ahead. Let's flip the board and have a look and a reminder of what is happening in terms of the sell-off in UK assets. And you've had this dimension of pound down, yields up, and that suggests to some at least that international investors are now putting a question mark over the broader investment case for the UK. We're getting back to kind of trust levels in terms of yields. Yields at almost a decade level high in terms of the 10-year. The 30-year at levels we haven't seen now, well above 5%, since about 1998. The pound is under pressure again today. This is a story of intense focus and importance, of course, for the Rachel Reeves team and the team around the Chancellor. And we'll see if they respond any further to assuage those concerns. Nvidia in focus today with the news that the Biden administration is working out more restrictions on AI accelerators, 3 different tiers. If you're an ally of the US, you get unlimited access. So we're OK on that front here. But if you're not, if you're China or Russia, you're going to be restricted almost entirely. That is the hope from the Biden administration. Then most of the world covered by a second tier. Well, they'll have to get support and backing and sign off from the US. The opening trade is up next. This is Bloomberg.